Okay, we're going to go over the reality of day trading, why most traders lose, and how we can beat the odds in the market using the correct approach. Okay, so these are the statistics of retail traders. Around 90% of traders lose money, and this is for prop firm specific. 80% of prop firm traders fail to make it past the evaluation stage. Only 5% of those that pass the evaluation manage to get a payout. And only a few of those that do manage payouts are able to consistently gain an edge and take profit out of the prop firm industry, right? So now this is not only because people are not very good at trading or managing their risk, but also because people do not know how to approach prop firms in the correct manner. So I'll be also be going over through a couple of modules explaining prop firms and how they're useful at each stage of your trading career, and also how you can kind of use prop firm to your own leverage once you're a bit more advanced, but we'll get into that later on. So retail traders unfortunately have a misconception of trading. They do not understand the markets, they do not understand why the markets move, they do not understand how the market moves, and most importantly, they do not understand why it's very important to go into the market with an edge and to always manage risk and to always use probabilistic trading, right? So unfortunately, people do not treat trading as a game of probabilities. They do not give themselves enough time in the market to gain an edge. They do not know how to contextualize the market and use discretion to tilt probabilities in their favor, right? So when we're first opening up the chart, the probabilities are 50-50, right? Once we start to contextualize the market by looking at certain tools and certain theories that we will cover, we'll be able to discern when probabilities might be shifting in our favor, and from there we can take a trade and manage our risk. And also, they do not focus on mindset tuning and ignore key risk management principles. This is because a lot of people treat trading like gambling. They buy an account, they try to pass it, they do not use risk management, they do not wait for proper convictions. And also, they're unable to contain their emotions during times of drawdown. Right? This is very important because everyone goes through drawdown. If you can't manage drawdown periods, you'll never be profitable long term. That's very important to remember. You're going to have to manage drawdown periods. So the misconception in trading, the reason why it's extremely damaging is because traders are reeled in by fake influencers who do lifestyle flash to sell signals and courses, right? You see that on Telegram, on Discord, on Twitter, on Instagram. A lot of influencers are pretending to be millionaire day traders, and a lot of them are getting caught out and lying very recently. But the thing is, these gurus do not highlight the losses and they flash their big wins, right? So we're already creating the first impression of day trading to retail traders. It's already a skewed conception. It's a wrong conception, and it's a very damaging conception, right? This is the first funnel that they go through. Okay. So this obviously forces a misconception on retail that this particular trader has a miracle strategy or an edge in the market. Remember how we discussed ICT telling people there's an algorithm and he cracked the code? So this gives people the idea that there's an answer to trading always, when that's not true at all. Failure to highlight losses but constantly flashing big wins is extremely dangerous for a beginner retail trader. When they do inevitably lose, when they get into trading, they are not properly equipped or prepared to handle the losses. So they're not equipped with the tools and they're not prepared mentally because they come in thinking it's all wins and it's all lifestyle changing. So this causes irrational windfall behavior, right? So not only is trading automatically very emotional, but you're getting a skewed misconception. And when this idea of trading is not met, these people go into tilt very, very quickly, right? That's why it's important that we're mindset tuning before we get into technicals, because we need to make sure we understand why the markets move, how they move, and also how we can operate within the markets. I want to mention loss aversion. So loss aversion is a research on cognitive bias in behavior economics. This is the psychological pain of losing. It highlights that it is about twice as powerful as the psychological pleasure of winning. This is important to remember. This kind of highlights that we're always fighting our human nature when trading. That's why trading is very hard. Because when you take a loss, you're gonna feel like shit. When you take a win, it's not gonna feel as good, right? And why does this happen? It's just human nature because we're humans. But what this means is people strongly prefer avoiding losses over acquiring gains. This ultimately leads to irrational decision making, irrational reaction to losing. They're unlikely to accept the loss and walk away. They're more likely to hold on to losing trades in order to not take a loss. So they're kind of avoiding the behavior they don't want to, the emotion they don't want to feel. They're trying to avoid it. And irrational profit taking because they're scared the trade's going to reverse. They take their profits too quickly, and this ruins their risk to reward parameters. They're increasing their stop loss to avoid pain of taking a losing trade. We kind of mentioned that. And there are many other economical behavior theory, but this is the most relevant as it highlights why we must manage risk and always be on top of our emotions, because this is human nature, and we must be able to stay on top of this if we want to make money. I want to go over tilt now. So tilt is a state of mental or emotional frustration. Think of it in the real world as like crashing out, when someone crashes out, right? So it's common in gaming and high stakes situations such as trading. Or think of someone like rage quitting the COD lobby and then playing shit after because he's so angry. You feel a sense of anger and toxicity. This leads to a downward spiral of actions. And in trading, a trader stops acting logically, starts making impulsive decisions, feels a sense of loss of control or body and action, and this ultimately leads to revenge trading. It is the core reason majority of traders are not profitable. So this is the main reason people are not profitable, not because of the inability to analyze the market correctly, because their inability to control their emotions when it really matters. And everyone struggles with this. Even the experts or the best traders will have bad days, but we have a systems in place that protects us from the bad days, right? We kind of need to minimize the downward spiral. Signs of tilt: revenge trading, immediately entering a trade after a loss to make it back. Size increase, adding more size on the next trade to cover for losses. Ignoring your stop losses. Not wanting to take another loss. Widening stops, hoping the market reverses. Or if you have real life anxiety, like your heart beating fast and things like that. The damage of tilt: revenge trading will lead to trading without an edge. So you're no longer thinking of trying to use probabilities to your advantage, using proper risk management, getting in at optimal points. You're now trading without an edge. This will lead to wiping out some hard-earned gains. A lot of people would make money for 2 weeks being very disciplined, and one annoying day and they crash out and they lose everything. And this often means the user is diverging from their pre-planned risk parameters and market approach. It can create a downwards behavioral spiral, and you must always be aware of emotions and ensure tilt, when it does occur, is managed and contained so we don't form a habit out of it. Why do we tilt? It is in our human nature. Loss aversion, as we discussed. This is the main reason why it's easy to tilt. We do not approach the market with correct expectation or mindset. This comes down to what we discussed earlier with influencers and people having the wrong mindset. External factors may impact our trading abilities. So if you have a fight with your girlfriend or whatever, and the markets will always test your emotions sooner or later. So market randomness can sometimes mean you are right about buys, but you still lose. Marginal stop outs, then trade reverses in your favor. You lose, but trade goes your way. Market can test our patience. Prolonged bad trading environments. Remember how we discussed a lot of choppy environments can occur? It's important to understand that you cannot beat tilt inherently, and it's impossible to always control your emotions. There are times you may feel that you are in control, and you may feel in control for a long period of time, but one bad day can catch you off guard, right? Especially as a beginner trader, your main priority should be not to beat tilt, but your main priority should be to have a system in place that reduces the possible negative impact tilt has on your trading. So we'll go through that and I'll teach you how to kind of set that up. This can be done by daily predetermining certain parameters that control you from market randomness and your any downward spiral. And ideally, we all want to be stoic. We don't want to feel our emotions, but the idea of completely removing emotions from your trading is not really possible. But you do get better at managing your emotions as the more often you do go through them. You're likely never going to stop feeling, but you will get better at managing those feelings. And how quick you get better at it, it comes down to whether you OODA loop, and I'll show you how to do that.